All right, guys. All right, guys. We're going to go ahead and start winding down and go ahead and get started. We're good. All right, guys. As you can see, the best real estate in the house are the people that get here early, right? We only have a few chairs, right? So it'll be standing room only. There's drinks in the back of the fridge if you want some, waters, alcohol there. But tonight we're gonna hopefully give you some value, and then we'll let you guys hang out again afterwards, right, and do some more networking. So what we always like to say as we do these, and we've been doing these now for around 3 years. Right, this is our new office since January. We typically did them in the at the brewery in Alexandria, but this is an area for you to, one, learn from somebody that has almost 2,000 units. So let's, awesome. But two, it's to learn. It's to get with individuals. I'm gonna have to turn that line down. Sorry. Is to interact with individuals that are actively doing deals in the DMV space. Right, and that's what this is here. So as you build the connections, build the relationships, build the relationships, get a coffee outside of this meeting, right? Start doing deals with the people that are in this room, because everybody here has a different specialty. So we like to see who's in the room. So if you are a lender, you've got money, raise your hand, right? So we have 2 hard money lenders and then residential and commercial debt, right? If you are a title company, raise your hand. Title company, Allied Title. If you are insurance, wholesaling, if you're doing any wholesaling, you've got off market. If you're doing short-term rentals, a few short-term rental people. If you're doing multifamily, which is what we're all here to learn about, multifamily. If you're doing commercial real estate, retail, office, flex, right? So there's somebody in here that you could learn from and interact with and do a deal with, right? So get to know them, get their card, build relationships. Come back next month and let's continue to do deals in this with people that are in this room. All right. That being said, Felipe, Ernest, how many units now? What's the count?
We're at over 1,900 now.
1,900 multifamily units.
Next month we'll break 2,000.
2,000 units. This guy has been around the block. We're going to be talking about the state of the market because he is a DC, Maryland, nothing in Virginia.
Nothing yet.
Yeah. I'll touch a little bit on Virginia multifamily, but we're going to talk about some good, some bad, how you're buying deals right now, how you're properly managing those deals right now, and we want to field questions. So if you have questions, come up here and write it up on the board, and then also you can raise your hand too. And then one thing that we always do with these meetups is to the end of the year, we're actually doing a giveaway for all the people that come and register and give us your email, right? Because we are going to send you emails after this. So if you put your business card in this little bucket, or we're working on getting the QR code, Michael Cook has an Airbnb at Massanutten Mountain that we are going to give away to somebody that has come to one of these events, right? So you can take your family for a free weekend. I'm going to pay for it. So that's the benefit of continuing to come back. Your name gets thrown in the hat. So put your business card there, and we'll write your name and number on there and put it in the thing. So let's talk about multifamily real estate.
Awesome. Thank you. Thank you guys so much for coming. I really appreciate it.
So let's give them a round of applause. I want to talk about the deal that you just closed to start this off. Probably your nicest piece of real estate.
Yep, definitely our nicest real estate. So we just closed on a 28-unit in Calorama. The address is 2116 Calorama Road. And it was a failed condo deal. So it was a hotel to condo conversion. And the previous owner bought this hotel. It was over 40 keys for $4 million. They pumped over $10 million into it. So they were in it for over $14 million. It was marketed by Northmark, and we ultimately threw in an LOI at around 11 million, which is where the numbers penciled for us. So we went back and forth, and they were projecting these out sales on the condos between $500,000 to $700,000. Obviously, this is one of the nicest neighborhoods in Washington D.C. Jeff Bezos' house there, a couple blocks away, and the market just turned. Right, they weren't able to sell the condos for what they wanted for. And they ended up taking a sizable haircut. And what was crazy is I found, through one of my associates that I met through the Georgetown Master's program, who's a student of mine, he sourced the equity for this deal. So we ended up buying the deal for $10.7 million all cash. This high net worth individual that owns over 1,200 gas stations across the US literally wrote a check for the whole thing. We ended up bringing zero money to the table as the GP. And the way the economics work is we were able to get 20% of the promote above a 7% hurdle. So that's kind of like our incentive and our fee for the deal. So we were able to source the deal, put no money down, right, and get 20% of the upside over a 7% hurdle. And that's how the economics ultimately came. But for me and the platform that I'm building, I literally forwarded an email to my associate, and my associate literally carried that deal from that email reception to the closing table and utilized our platform and our network and our brand and our name in DC in order to get the deal. But and I don't want to get too deep into the weeds, but with one of the negotiations, and I can answer your question in a second, was so here we were, we have $11 million commitment from this guy. Apparently he makes, $250,000 every 2 hours. Can you imagine? Like ridiculously wealthy. And he almost didn't want to do it because $11 million was like so insignificant to this guy. And for us, like we're all like pacing around the room, like freaking out about this. And like 2 or 3 weeks before our deposit went hard, we had a $2 million deposit that this guy posted up. I was like, you know what? It'd probably be prudent to do a property condition assessment, just in case. And a property condition assessment is a report where someone comes and just analyzes the property, make sure they kind of tell you what's going on. And I was like, everything is brand new. Like, what's going to pop in the report? Typically, I like those reports when it's like an old building and they're like, hey, the boiler's going to blow up in 2 days and like all those things. And the property condition assessment literally flagged that the elevator hadn't been replaced in 35 years and they had skimped out and not done that. So luckily, obviously, I look at the elevator and I'm like, this looks functional to me. They redid the panels or whatever. And so we got a quote for the elevator, and we got a quote for $400,000 to $500,000 to replace this elevator. So imagine this was something that we're like, hey, look, everything looks great. They spent $10 million renovation on this building. You think you're getting a new building, and then boom, you get hit with a $400,000 or $500,000 bill out of nowhere, and you're like, whoa, I wasn't expecting this. So remember, the sellers are taking many $1 million haircut on this deal, right? And then we had the audacity to go back to them and ask for a price reduction because we didn't anticipate this large expense that we were going to have to incur. So we were negotiating, going back and forth with the seller, like they're already, at their wit's end because they're losing a ton of money on this thing already. And we negotiated a price reduction of $225,000 on the elevator. We're all pumped, right? We're like, oh my God, we can beat them up a little more. They'll pay for half the elevator. And we call our LP, we call this high net worth individual, and we're like, hey, we got 225 off of it, thinking he was going to be like amazing, great work, great negotiation. He goes 225. He's like, Felipe, it's 300. And I'm like, what do you mean it's 300? He's like, it's 300 or we're walking. And I was like, what? I was like, can you repeat that? And he's like, it's 300 or we're walking. I'm like, so you're telling me that over $75,000, which I know is a lot of money, but contextually speaking on an $11 million deal is really nothing, right? I was like, over $75,000, we're going to lose this opportunity. And he goes, that's exactly what I'm telling you. So at that point, I'm like thinking the whole deal is blowing up. Here we all excited buying the nicest deal in Calorama, nicest deal in our portfolio, freaking out, right? So I drafted up this email, and my associate was running the whole thing. So now I'm emailing them, like now the boss is like stepping in, like, hey, shit's about to go down. So I email and I'm like, hey guys, I know I'm being incredibly unreasonable. I'd like prefaced it with like, this is insane what I'm about to tell you. But if you don't sign the attached amendment to the contract by 4:58 today, this thing's done. Like we're walking. And I was like pacing back in the room. I was like, my God, are they going to sign it? They're not going to sign it. Yeah, literally. And it was 1 p.m. on a Friday. Literally 4:59, we get an email, please see attached. And the thing was there. And then at that point, we were going hard on $2 million. So I knew we were closing, right? My associate who never closed a deal before, he's like, why are you so happy? I'm like, bro, we're hard on $2 million. Like we're buying this thing. Like there's no going back now, and then we ended up closing it a week later and it was a beautiful thing. So that was the last deal we just closed. But it goes to show you how structuring and how relationships, everyone always thinks you need to have a lot of money to get into real estate and you need to have all these contacts like that. Obviously it helps if you have those things, but finding good deals and stuff like that really leads to opportunities if you position and structure them the right way. So I know you had a question.
I do. So you talked about a 7 pref with an 80-20, right?
Yeah.
So how does that work? In other words, the $11 million guy is going to get a 7% return on his money.
Correct.
And then he's going to get 80%, and then you guys are going to get 20%?
Correct. After that 7%. Exactly. That's how the waterfall is structured. Sure. But remember, the building's vacant right now, which is great because we didn't have to deal with TOPA. One, we have to deal with this elevator, which has a 4-month lead time. So I'm already thinking about how we're going to get $4,000 or $5,000 a month while people have to walk up 5 stories for that. So I'm like freaking out about that and the concessions that we're gonna have to offer. That's besides the point. Once we stabilize the property and we fully lease it's already renovated, then we're gonna refinance.
Yes.
And then we're gonna take that capital, we're gonna pay them back. We honestly think it's worth a lot more than 10.7. So hopefully it appraises for 14.15. We can refinance out 10 million plus, pay him back all this money. And at that point, once we've repaid him his money back, then at that point, once we catch up 107% of his money to that point, then every incremental dividend dollar goes 20% to us, 80% to him.
Yeah, but then what's the timeline?
On the refi?
Yeah, with that.
Typically, we'll see how long this guy wants to own it. Obviously, it depends on where your LP is coming from, but we're planning on refinancing this in day 366. Because with agency, you really want to have a year of seasoning in order to get to that loan of value versus that loan of cost. Because you don't want to be constrained to loan of cost. And after 365 days, Fannie Mae and Freddie Mac feel comfortable lending you 100% loan of cost. So at that point, we're hoping, obviously, if everything goes according to plan, interest rates cooperate and everything, that we refinance 100% of the guy's money back. And then at that point, the split kicks in indefinitely.
You have a DSCR requirement.
Well, the DSCR it'll appraise and it'll be a 1.2 DSCR or 1.25 or whatever. Obviously the loan will have to size up to the requirements of the lender.
So I have 2 points on that. One, the brand that you've built is what created the lead, right? So like the relationships that you build in these rooms are very, very important, but the brand that he has built, that, hey, he is now the guy to call on multifamily in Washington, D.C., he's going to get it closed. Brokers want to make commissions. So if you want to buy real estate and have brokers bring you deals, when they bring you a deal, you execute on it. Right. And that's probably why you are getting 90% of your deals now, because of the reputation.
That's exactly right. And now everyone calls me, right? Like people are always calling me and saying, hey, I have an off-market opportunity, hoping that I'm excited enough to buy it. But now that I've grown so much, I'm being way more selective on what I buy. And I'm really looking for stuff that's heavily in distress because of the opportunity, right? I don't want to stretch for something because I don't have to.
Yeah, you should find it in DC for sure.
Yeah, it's all over DC. I mean, this deal in Colorado, right? The nicest neighborhood in DC, you would think, is insulated from distress, but distress is happening in every neighborhood in DC.
And the second point I wanted to touch on was where his value add distress was. Because obviously the asset is distressed from an ownership perspective, but it's
Amazing condition.
brand new.
Yeah.
So we talk about the 5 cycles. So acquisition, rehab, stabilization, disposition, return of capital. So his value is going to be in stage 3, which is the stabilization.
Mm-hmm.
The property management aspect of this deal is what's going to make or break that refinance.
Correct.
And that's when the dispo happens, and then he's going to get his guy back.
Right.
You get
And that's the thing is in today's market, there's a lot of great real estate. Like this is a great real estate, but there's balance sheets that are upside down, right? Like they spent too much money because, and the market turned, and now all of a sudden they're caught with their pants down and they lost money.
So let's talk about that. Today's market, and that's kind of what the topic of this is, the state of DC real estate. Is the stadium changing things? Is the new president changing things? What is occurring in DC?
Yeah, there's a lot happening right now. It's incredibly challenging. DC is an incredibly challenging market to do business in. There's a lot of bureaucracy. And obviously right now I'm raising a lot of money from not just DC, but really all over the world. And what are people seeing? They're seeing Fox News, CNN, DC, militarized, right? They're sending ICE and all this stuff. So there's a huge impact. And here I am trying to pitch, oh, you should invest in DC. And they're saying, Fox News militarizing DC. They're like, wait a second, like what you're saying is completely different. And that's where I'm pitching the opportunity. I'm like, you're right, the city is on fire. And that's why we're buying things for 60 cents on the dollar. And when things rebound, which they will, because it's the capital of the US, we're going to look back on it and be like, that was such a great opportunity to capitalize on that real estate. So I really think that right now is a fantastic time to buy. But you just want to make sure that you're not over leveraged. You want to make sure that you're adequately capitalized because, it always costs more money than you think. It always takes longer than you think, right? Things don't go according to plan. And when you run out of money, because really cash is oxygen in this business, that's when you get caught and, you make decisions out of distress, right? But, a couple of the pros and cons, right? One of the pros that I think that Donald Trump really did in DC, which I'm a huge fan of, is forcing everyone to go back to work. You know what I mean? Like K Street was a ghost town. Chinatown was a ghost town. I know a lot of people don't like that, especially, W2 employees that go to the office every day and have to get in their car. But for the city, it's vital. You know, the coffee shop on the corner of 14th and K is relying on JLL having a full building. So, and then selfishly, I'm like, oh, I want everyone to go back to work, but I don't want my wife to go to work. I want her to stay home. You know what I mean? And she goes to work 2 days. She works from home 2 days a week and goes to the office 3 days a week, which I think is a good balance. But one of the things that I think that Donald Trump did that was really amazing was that it forced the federal government to go back to work, which I'm a huge fan of, right? Because people need to stop work. I don't know, maybe I'm kind of call BS on people. I think people work 20 minutes a day on their laptop and then watch Netflix and kind of like screw up all day. That's what I think that the average person's doing, but maybe I hope I'm wrong. But being in the office, at least, like you're with your peers and like you're forced to, I think, maybe work 3 or 4 hours a day instead of, being at home in your PJs and in your couch. Another thing that I feel like, obviously, all this militarization that's happening, obviously it's really scary. And I think that having police officers and military kind of like attacking regular civilians is completely insane, right? Like we're literally creating like a war in downtown DC. But I do think that there's going to be a positive ripple effect from this because crime is going to go down inherently, right? Like people now are more careful because they know that things, that there's more, law enforcement around. So I think that one of the ripple effects of this militarization will be that DC will be a safer place. And quite frankly, the crime in DC has gotten out of control. The second I crossed the bridge and I came here on my scooter, literally I was like, damn, Virginia feels so safe, man. I was just driving my scooter. I was like, I feel like I don't have to watch over my shoulder over here. When I'm in DC, like I spend a lot of time in seedy neighborhoods and I'm just like the whole time I'm just like this, I'm just like watching like people around me all the time. So I do think that the crime in DC has gotten out of control. And I think that, these kind of decisions, although, I don't think he might be implementing it the right way, that will have a positive ripple effect.
Takes time.
It will take time.
And he did. First of all, this man drove a 150cc moped here.
Yep.
He did. It's parked out there. If you guys want to see his whip,
Yep.
It's not 2,000 units.
Yep.
He's not driving a Ferrari.
Yep.
Right? So that's one thing about real estate is that we're always cash
Free
poor,
parking.
equity
Yep.
rich.
That's
Right.
exactly
That's
right.
one thing.
Yep.
But he did. The first thing he said was, "I feel like this Virginia feels safe." Right. And that's something that you have to think about when you're putting your money in dollars to work in a certain market, right? Like if you're going to be boots on the ground type of person, if you're buying your first quadplex, right, and you're going to be going to that, picking up rents and during the stabilization phase, interacting with tenants, you have to have the stomach for it. Right. So two things that you touched on, 60 cents on the dollar. So I want to you talk a lot about basis. Buying based on price per door, and then also over leveraging. Tell everyone about what that looks like.
So the basis is how much you're paying for something, right? Like if you buy an apartment building and you're paying $100,000 a door, right? That it costs $200,000 to $300,000 a door just to replace that building. So already like you're getting good price. And the thing about price is that it's fixed, right? Like you pay $200,000 for a condo, like that $200,000 is what you're paying for it. Whether it's, 2 years from now, 5 years from now, like that's the price. And obviously not just in real estate, but in business, the lower you pay for something, the higher the probability of you doing well on it and you making money on it, right? So in real estate, they always say you make money on the buy, right? Making money on the buy means that you're buying something for cheap and therefore with time, hopefully it appreciates. And the great thing about real estate is that you rent it out to a bunch of tenants that are paying your mortgage for you, right? And that mortgage is then amortizing. So it's lowering every month so that over time, 5, 10, 15, 20 years, ideally you pay off your mortgage so that you have no more debt. And at that point, if you bought it at a great basis, right, at a low price, you have the tenants that paid off the mortgage for you. Then at that point, when you sell the property, right, whatever you sell it for, you're walking away with a massive gain. And on top of that, you only have to pay capital gains tax, right, not ordinary income like everyone that has a W-2 income, which means that you're paying less tax on whatever, the exit sale is.
And to give an example, he bought the building for $11 million. The developer bought it for $4 million. He put 10 in there. So he bought it less than the replacement cost.
Correct.
Of what it would have cost for him to build that from the ground up, right? Hypothetically, that's a good buy, right? Because I don't foresee the cost of materials from an inflationary perspective going down 25%.
And with tariffs now too, obviously, that's another conversation is tariffs are, the taxes on everything is going to go up. So if anything that you're buying right now is going to be even more expensive to build in the future. And therefore, when you buy it in the future, it's just going to be more expensive because it costs more to build at that point. That's why I really think that now is such an amazing time to buy real estate, obviously at the right price, because everything's going to get more expensive. And a lot of people are adverse to buying real estate right now because interest rates are high. So they're like, oh shit, like I don't want to pay, like I lived on 14th and U Street and I had an interest rate of 2.75%. I ended up selling that house because I had kids, and now I live in a house where my interest rate is 5.75%, right? So my mortgage basically doubled from what I was paying, but I got the house at a great price, right? And I got a much nicer house at a great price. So now what do you think is going to happen? Interest rates are obviously going to come down over time. I'm not in a rush, so I'm going to pick my spots. I'm going to be like, okay, usually I like to refinance every 100 basis points. Whenever interest rates drop 1%, like from 5.75 to 4.75, 3.75, that's usually like when I like to refinance because of closing costs. And at that point, I got the house at a great price. I will refinance to lower my payments as rates come down. And as the value of the house keeps appreciating over time, especially with tariffs and everything, I could even refinance and pull out more money if I wanted to, and then have access to that capital. And because interest rates went down, my payment could in theory be the same. So you can pay the same amount of interest while having the bank give you, I don't know, $100,000 or whatever it is. And at that point, that's your money that you can go out and in theory invest it and hopefully make more money than the bank is charging you, so that you can arbitrage a positive return out of that.
So over leveraging and DSCR, right? Because that goes back to that when he said he's going to refinance it and pull some additional cash out. The one risk with that is the over leveraging, right? So essentially you're putting more debt on the property than the property can service. Mm-hmm. Right? And that's what he was talking about as a 1-2 DSCR, debt service coverage ratio. Usually banks, Freddie, Fannie, want to see a 1-2 DSCR. Now, Afia and I right now are looking at she's doing a 1031 exchange into something. We have a loan that'll do a 1-0 DSCR, right? But still, we're having trouble making it work in this market. And it's all because of interest rates. So what is the solution to that problem?
So a 1.2, typically it's a 1.25 debt service coverage ratio. And what that basically means is that for every dollar of profit the property has of NOI, you need to have 25% more. So you need to have 25% more profit. So for every dollar of debt that you have, you need to be making $1.25 of profit. So that means there's a 25-cent margin. Basically, you have a vacancy, you have delinquency or whatever. You need the profit to dip by 25% in order to be in jeopardy of not being able to pay your mortgage. Okay? So that's what the bank is doing. The bank is sizing up how much profit you're making on it. And then they'll say, okay, the bank, we think that you're making $125,000 in profit on this asset per year. Therefore, we're comfortable lending you, they'll size up a mortgage depending on what interest rates are at the time. We feel comfortable lending you a loan of X that costs $100,000 per year to service. So in theory, you're going to be making $25,000 in profit after paying your mortgage, right? And then what you should do is you should take that $25,000 in profit mortgage. And what I like to do is I like to divide it by the amount of equity that you're putting in the deal. Because what that ultimately does is that calculates the return on your investment, on your personal cash. Like if I'm writing a check, right, for $100,000 and I'm making, $25,000, that means that I'm making a 25% return on my money, which in real estate is an amazing return, right? So that's how I'm always thinking. It's for every dollar that I'm putting of my own money, how much money am I making on that money, right? Because that's what I'm interested in. And second of all, I'm leveraging the bank in order to get a better deal for myself, because in theory, the bank is charging me 5 or 6%. I want to be making over 5 or 6% on that real estate so that I get positive leverage, right, on that deal. Because if the bank is lending me let's say you have a deal that costs $100,000 and the bank is lending you $75,000 and the interest rate is 5%. If you're making 6% on the whole deal, on the whole $100,000, that means that you only have to pay 5% to the $75,000. That leaves the $25,000 that you're putting in gets the positive leverage over the return that the building's getting over what you're paying the bank, and that juices your overall return. Does that make sense? I know it's a little complicated, but basically what I'm saying is that I'm leveraging the bank, and the bank is charging a lower interest rate than the return that I'm getting on the property, and therefore that's juicing the return for my investment. And that is what you want to try and do. And if you have the opposite of that, if the return on the building is lower than the interest rate that the bank is charging you, then you have negative leverage. And negative leverage is a bad thing. because that means the bank is gaming you.
Correct. And so one of the things too that Felipe is, as he's talking about NOI, the goal of a multifamily and commercial investor is to increase your NOI. You can do that through increasing income, which is getting our rents to market rate, adding more units, maybe finding another way to add additional income through laundry, storage, pets, all the such, or we decrease our expenses. Is that splitting water? Is that
investing in low flow toilets,
Yeah,
investing in LED lighting, getting a cheaper
All these
cleaning
different
contract,
things.
getting a lower insurance contract, right? There's only two ways of making money in business and in real estate, really. It's either increasing revenues or decreasing expenses, right? And your NOI, which stands for your net operating income, is the profit that building is generating before the mortgage, right? And remember, if he takes out a mortgage or if I take out a mortgage, the bank is going to view us differently depending on how many assets you have, what your current track record is. I might get a more favorable mortgage than him, or he might get a more favorable mortgage than me. And that's why everyone looks at NOI, because NOI doesn't take debt into account. NOI only looks at the revenues and the expenses of the buildings, unrelated to who owns the building. Obviously, I can manage the building more efficiently than the current owner, and that could be my value at play, right? Which I do a lot of the times, especially because I manage my own properties and I have my own management company. So I'm thinking, Borger is currently managing this property as a third-party property management company. Therefore, they pay, they have in current profit that they're making, right? And by managing myself, I could, in theory, run it more efficiently because I don't have to pay that profit to someone else. So that's partially one of the reasons why we're fully vertically integrated, which means that we do everything ourselves because one, control, because I'm a control freak, and two, because I like to control the expenses and I like to try and run things more efficiently than just outsourcing it to somebody on the street.
Because I think property management, once you own the asset, buying it, you said this to me one day. We were having coffee in Starbucks. So everybody on LinkedIn always celebrates when they buy a building, right? That's just the start.
Don't celebrate that. I mean, you should
Yeah,
celebrate that.
you celebrate it. That's great, right? But now, guess what? Your life just got way busier for buying that building. Now you have 28 units to stabilize, right? You have 28 units. You have 28 tenants to service.
Yeah, the
You
elevator.
have to get those things operated. You have to fix the elevator. Like those, that is the business.
Right.
Is the operation of the asset. Right?
And
then you get to see the profits.
Correct. And that's why I would say any Joe Schmo can buy real estate, I would say, but can you make money buying real estate? And more importantly, I really like to celebrate once we close a refinance or once we sell the asset and make money, because that shows that the property was a success. You know what I mean? Don't get me wrong, buying real estate is really hard and you should be happy when you buy real estate, but you're incurring a lot of headaches. And now so many people are sending me opportunities, great opportunities, that I'm just like, this is such a headache. Someone sent me a 70-unit property in Brightwood at $50,000 a door. $50,000 a door. That it's the cheapest basis on a price per pound in all of DC for the last 5 years. And honestly, I was obviously considering it because I was like, oh my God, this is the best basis ever. But then once you think about the fact that you have to pump $100,000 a door per unit just to get it up to code and where it needs to be, dealing with the headache of the tenants, dealing with the government that's literally all over the asset because it was in receivership. And I'm like, you know what? This is going to take, I only have a certain amount of time in my life. This is going to be it's going to take, but at the same time, could I have made millions of dollars doing that deal? Probably. But at this point, I'm really focused on the opportunity cost and my time because I can go down, I've been down these rabbit holes, right? And been chasing these amazing deals. And then what ultimately happens is it just becomes a huge headache and hopefully you make money on it at the end.
It's a phase of your investing career too.
Yeah.
At first you have to chase,
right?
You're going to have to get gritty with it unless you have endless capital. You're going to have to show up and find ways to have a competitive advantage, right? Whether that's construction, property management, whether you're knocking on doors to help source the deal, right? Or you have good relationships with wholesalers. You have to do that, right? But then once you get to a certain stage, you can start picking and choosing your battles. And in most cases, you're going to pick the ones that are going to be the most profitable with the least amount of work.
Correct. And that's what I'm trying to get better at saying no.
No.
Because I love saying yes, but you only have a certain amount of time and then you pay for saying yes. So it better be the juice better be worth the squeeze, right? If you're going to go out and bust your ass on it, then you want to make sure that it's worth it. And sometimes I've learned the hard way that it's not always worth it.
Let's open it up to questions. Let's get, okay, you go first, yeah.
All right. when you were negotiating with the $11 million man, what made you decide to go pref 7, 80, 20?
Mhm.
Why not go pref 8, 70, 30, or even higher, just because you want to take on the 8% risk?
Honestly, it was a negotiation. Obviously, we're looking for the lowest hurdle possible, right? Because we're the general partner in the deal. But there was precedent of him doing this deal before us, so that was kind of what he was accustomed to. But
I get it.
the answer is it's all a negotiation. You know what I mean? It's whatever the guy agrees to on the spot. Had he said 8%, we probably would have still said yes. Obviously, we wanted 6%, right? So the whole thing is a negotiation. And what I've noticed is this is a high net worth rich guy that didn't even look at the model and has a group of quants that's just kind of saying this looks good or doesn't look good. Once you start raising capital from institutional partners, which we're in the process of doing right now, we're raising money from a group called GCM Grosvenor that has over $80 billion. That is really expensive capital, right? They know that you're paying for the name on the door, and therefore the splits are going to be a lot more favorable for them because it's their money and you need their money. The best money is the family and friends, your rich uncle, the guy that's doesn't know anything about real estate. And you're like, hey man, let's just split everything 50-50, right? Not to say you're taking advantage of people or whatever. I did a couple of deals where people thought I got too good of a deal, right? And people were like, hey, don't you feel bad? And I go, no, I don't feel bad because he was happy, I was happy. So what's the problem, right? If we're all happy, but people were like, yeah, but that's not the industry norm. He should have gone more. And I'm like, yeah, maybe he should have gone more, but at the end of the day, he was happy with what he got. So what's the problem? So everything is negotiable. I just want to obviously there's a standard thing. And the standard is this is what we do on our typical model is an 8% return is pretty common. And then after an 8% return, from an 8% to a 15% return, 70% of the money goes to the limited partner, which is the guy that's writing the check. And 30% of the money goes to the general partner, which in this case is you guys, right? Me, the guy running the show. And then after a 15% return, then everything goes 50-50. And I've been doing a lot of that structure. That's basically very basic syndication. That's industry standard syndication. But once you go to the Blackstones of the world, they're not going to let you get away with 50% of the profit after a 15% return. They're going to say, hey, we want 80% or, whatever they decide that they want.
And I think you have to make a business decision too. We talk about it internally. We want good money. We don't want bad money that's going to be a headache, right? We want individuals that are aligned with what we are doing, right? So if they aren't aligned with you, just say no.
Yeah.
There will always be, if you are a good operator and you have access to good deals, the money will find you, right? And good money will find you because they are behind the brand of what you're doing.
Right.
They're excited. This guy is 33 years old.
Mm-hmm.
Right? Why would you not be excited to be behind that racehorse? Right? Blackstone can go fuck off.
Yeah.
Right? Honestly,
yeah. But to that point, in the beginning, beggars can't be choosers, right? You're asking for someone to give you a chance. So you really can't be in a position to turn down money. So hopefully you get lucky, you get good money. But having raised, a lot of money, and now my portfolio is worth, $300 or $400 million. I've raised money from bad people. I've raised bad money. You know what I mean? And looking back on it, I don't know if I regret it because I learned a lot from it, but I definitely won't go back to those people for more money. You know what I mean? So raising money from the right people is so critically important. And in the beginning, it's so hard because you don't know anyone and everyone's giving you a shot. So you're kind of just hoping that someone's yeah, I'll give you a check and see how it goes. But as you get more and more, obviously, deals done, hopefully you can be more selective, in deciding where you get your capital from. But I'm telling you, there's nothing like bad money, audits, lawsuits, it can get really, really ugly.
Weekly updates on the stabilization phase.
Exactly.
It takes away from the operational aspect of it.
And sometimes it could be for a small check, $10,000.
Those are usually
those are the worst, because then it's man, how I give me $1 million, I'd be like, all right, well, it was worth it.
Yeah.
But over 10 grand, I'm like, damn, why am I dealing with
I'm trying to help you.
Yeah.
That's
exactly. What else? I think you had a question in the back.
Oh, I think you were.
Yeah.
Gotcha. What was the first deal you were involved in? And then you kind of already touched on this with the lesson, but are there 2 or 3 big time lessons that you learned from deals not going well that you would use on a daily basis?
So the first deal that I acquired was a 2-unit across the street from the Shaw Metro, which is on 6th and Rhode Island in Northwest. It's around the corner from Dacha Beer Garden, if anyone kind of knows where that is, near kind of Chinatown area. And I bought it off Redfin, right? Because I was 23 years old and didn't know what I was doing. And I thought that I can operate it as a 3 unit because I didn't know what a certificate of occupancy was. So literally I went to like IKEA and Home Depot and like turned this thing into a 3 unit. Luckily it had a CFO for 2 units. So I guess I had something going. And then I ultimately ended up selling the property because I didn't like the liability of managing it as a 3 unit. So I ended up selling. So that was the first deal that I did. And that was all back of the napkin, like math, right? I was like, I think I can rent the top floor for $2,800. I think I can rent, so that's like $8,000. And I think my property taxes are going to be this. And this guy told me my insurance was going to be this. And I think my power bill is going to be this. And then ultimately this is how much profit I'm going to be making. But the whole thing was like, just throwing shit at a wall and hoping that it sticks. Then I ultimately did my master's at Georgetown in the real estate program. And that's where I got a formal education because you have to know the language, right? You have to know what IRR is. You have to know what an equity multiple is. You have to know what, cash on cash is. Because if you don't know these terms, like then people don't think that you're legit, right? It's like not speaking the language of real estate, like when I call a lender and he's like, hey, what's your debt service coverage ratio? Or what's your DSCR? Not even debt service coverage ratio. And you're thinking, what is that? Then you can already think like the guy's not going to lend you money, right? So having a basic language and understanding the lingo is of critical importance. I love the Georgetown Master's program. Obviously, I'm a big Georgetown guy. I did my undergrad and master's, and I'm a professor there now. What's cool is that it's a night program, so you can go from 520 to 750 at night. You can have a full-time job. It's $30,000 or $40,000, which for a master's at Georgetown is not crazy. So that was the first deal that I did. Lessons learned. I mean, there's so many. Honestly, I want to write a book once I'm done. And honestly, most of the lessons that I learned is in property management. I mean, I have some like really, really crazy stories, like, gun related, drug related, just like I evicted 12, a drug syndicate in Tacoma Park, 12 units in one day. And I decided to show up. The marshal was there. Like one of the tenants pulled out a gun on the marshal. Like, can you imagine? And I'm like standing like right next to him, like, oh my God, like mom, I like dove in my car, like that was like not even that bad. That was just like a bad day. Yeah. So there is some stuff that I don't even feel comfortable sharing because it's so gross. But one of the real lessons that I learned was, and this is really hard to do. So I want to preface it with that is, you want to buy a deal, you don't have that much money, right? You're saving up money and you have just enough money to put your last dollar to make the deal happen, right? So you would save up $20,000, $30,000, maybe you're doing an FHA loan and you have to put your last dollar in the deal, right? That's incredibly dangerous because once you close and the hot water heater blows up, right? And you didn't account for that $5,000 or $7,000 and now all of a sudden you don't have any money for that. Now you're in distress. Right. And now you're going to be forced to go to someone and borrow some money and it's going to be predatory money because they know they have you because you need them. Right. Like I never like going to people when I need them. I like to go to them once I'm like, hey, I have an opportunity. You're interested. And it's funny when I'm raising money, the first thing I do once I've closed out the raise, which means I've raised all the money, is I call everyone that was on the fence and I'm like, hey, we're done. Yeah, we're done. Yep. Sorry, we're done. And what does that create? That creates FOMO. Right. So now everyone's like, oh, shit. Like I wanted to invest in that. I'm like, oh damn, you did. Well, it's too late now. So, maybe next time, right? Maybe next time you'll move quicker. So that's what I'm saying is like, as crazy as it sounds through COVID and through kind of like all of the market volatility that we've had, with inflation, with COVID, with the political landscape changing, is having a safety net is so critically important where like, I want to make sure that I'm not worried about paying my mortgage this month. I want to make sure that if tomorrow someone hits me up for $10,000, like I'm not worried about it. So it's so hard to do that when you're starting out because you have so little resources and you have to turn nothing into something. So being disciplined enough to be like, hey, look, I'm going to put the first $10,000 towards my saving account. That's like literally I'm not even going to touch, and I'm going to put it in a CD making 3 or 4%. And then after that, the next $25,000, I'm going to start investing in my deal. That's a lesson where like, if I didn't have that safety net along the way, I would have gone bankrupt many times over, right? Because I would put my last dollar in the deal, some shit would have blown up, I wouldn't have had the money, and then I would have been exposed, right? So having reserves is such a critical component, and it's so hard because you're just starting out, right? Like, what do you mean I have to have reserves? Like, I don't even have enough money to do the deal, right?
And in most cases, the lender is going to require you to show some type of reserves.
Exactly,
Right?
exactly.
So
I would
they'll be
say,
an accountability partner for that.
That's a big one. Another one that I would strongly recommend when you're starting out, and he comes in and guest lectures in my class all the time, is you know, your first deal, you're not going to get rich off of it. You're not going to retire on it, right? Like the first deal is just kind of like learning how to play, like learning how to do. So what I would recommend for the first deal is go for something conservative, go for something where you're like, hey, look, I'm clipping a 5-6% return on my money. It's going to appreciate over time, and it's in a great neighborhood. You know, like the one thing your first deal you can't strike out on your first deal. You know what I mean? You can't go bankrupt on your first deal. So it's better to kind of aim small and go for like a single or a double, right? And be like, hey, look, like this is pretty safe because now you have a deal notch under your belt, right? At that point, you're like, all right, now I got one, now we got momentum. Maybe the next one you can take a little bit more risk. But swinging for the fences on your first deal and going for some like crazy like value add plan where you're like everything needs to go right in order to hit that like whatever you're aiming for, like you've never done it before. You know what I mean? So that's why I think it's better to start small and grow big over time. Like I've been doing this now for 10 years and my first deal was a 2-unit, my second deal was a 5-unit, and now I'm buying 192 units, 107 units, right? $20 million, $30 million, raising money from family offices in Colombia, in Luxembourg, like, and now these guys are all writing checks because of the platform that I've built, right? And on top of that, I present well with these guys, and I speak Spanish, I speak French, so then they're like, you have that connectivity that they're like, I trust this guy. He went to Georgetown, you know what I mean? So it's all about like presenting to capital and then trusting you. You know what I mean? And trust. And now one of the things that I did early on, another lesson is when you start out, you're trying to get everyone all excited, right? You're like, man, I found this great deal and like, it's going to be amazing. We're going to kill it. We're going to make so much money. Da, da, da. And I try and get everyone all jazzed up because why? I'm trying to get money from them. Like, I'm trying to get them all enthusiastic about it. And what ultimately happens is that you overpromise and you underdeliver, right? Because you stretch the model, you stretch your assumptions to present to them to be like, to make it look so sexy that they're like, wow, like I want to do this with you. Now I've learned I like the opposite. I'd rather be more conservative and over deliver and be like, hey man, I think we're gonna get 6%, but in reality I think we're gonna get 8 in my head. But I'm like, let me tell you we're gonna get 6. Because what I realize is if I tell you that you're gonna get a 6% return on your money and you get a 5, you're gonna be disappointed, right? Or that's an example. Let's say you thought you were gonna get an 8% return and you got a 7% return. You're going to be disappointed. A 7% return is still a fantastic return in real estate, right? But because you thought you were going to get an 8, you're disappointed. But if I told you we were going to get a 6 and you got a 7, then all of a sudden you're like, oh my God, this guy killed it. He outdid his pro forma. This is amazing, right? It's the same 7, but it's all about the perception that you're instilling in your investors, which caused them to be happy or sad for the same outcome that was going to happen. So early on in my career, I was like, oh man, I'm going to tell this guy I'm giving him a 10%. And then when he gets an 8, he's like, damn, like, what happened? And I'm like, holy shit, dude, you should be pumped. 8% is amazing. Like, this is great. He's like, yeah, but you said 10. And I'm like, I know I said 10, but like, you know, this, and this happened. And now I'm like, nah, I think we'll get a 5 or 6, you know, but the model, you know, and then when we get a 6 or a 7, then it's like, oh man, we beat it. But that's one of the things that I learned is now I rather be much more conservative and much more selective because I don't like to it's all about calibrating expectations. That's what I'm realizing, or that's what I've realized and learned. So hopefully that's a couple lessons that answers your question.
Yeah, mine was about the institutional capital point. I'm curious to hear about, I guess, what catalyzes that transition? Because you mentioned before, right, there's good money, there's bad money. And I would imagine if one has the wherewithal to just stay within that whole family office space, going institutional is not as desirable. So what is it that, I guess, really drove that? Is it like a scale thing? Is it more tapped out? Is it?
That's a great question. You know, it's being overly ambitious can be a bad thing. As crazy as that sounds, right? People always think like, oh, you're ambitious. Like, that's a great thing. Like sometimes enough is enough. You know what I mean? Like, is 2,000 units not enough? You know what I mean? My goal was 1,000 units. Right. And I think that I went from the family and friends round. Right. And I actually had an interesting business strategy, I thought, where I would go to a partner. Right. I'd go to someone like Cassidy and say, hey, Cassidy, let's partner on this. You go out and raise the capital, I'll source the deal and execute the business plan, and we'll partner on these deals together. So ultimately what I was doing is I was tapping into Cassidy's network, right, of his family and friends and stuff like that, and raising capital from his whole network. None of these people know who I am, right? Obviously we're leveraging our platform that we're building together. And ultimately what that did was it made the pizza pie so much bigger, right? Because instead of only having my own network, I was tapping into my network and think about how that compounds, right? Because it's like, imagine everyone in this room gave me a list of the top 10 wealthiest people that they know that want to invest in real estate, right? Think about what that would be like versus just me by myself, right? So that was one of the initial strategies that I had, which has pros and cons. One of the cons is obviously that Cassidy is getting half, but at the same time, he's the one that raised the money. One of the pros is that when some of these deals, and I've done over 50 transactions, once one of these deals inevitably goes sideways, I'm not going to go to Thanksgiving with Cassidy's aunt that we lost 100 grand for, who's going to be looking at him like, what the fuck did you do with my money? And I'm like, hey man, this is how these things go, right? Like sometimes they go well, sometimes they don't go well. So one of the things that I would recommend is kind of figuring out like where you want to be, like 5 to 10 years from now, like how much money do you want to make? What kind of life you want to live? And basically back solve to getting to that point, right? And for me, like I just want to keep growing. At this point, like I want to get to 1,000 units. Now I want to get to 2,000 units, and I want to get to 10,000 units. It's not even about the unit count anymore. It's about just building a generational multifamily investment vehicle where hopefully one day, you can go public or you can sell it to a Blackstone. And who knows? Like I just want to see at this point how far I can push it, right? Because it's just compounded so much. But at the same time, like there are growing pains. There are real growing pains associated with building a platform from you running a 4-unit and you collecting rent on Venmo like I did for the first 200 units to having institutional grade reporting like I have to adhere to MCB, who has a $3 billion fund out of Baltimore, and like Dave Ramble, a guy who's an institutional investor who's invested in our deals. He looked at me, he's like, Felipe, I'm not your rich uncle. Like he's like, you can't miss the quarterly reports on the 15th. You can't miss, like this is institutional grade. Like I have pension money behind this. This is serious. You know what I mean? So it really depends on where you're trying to get to, but undoubtedly family and friends capital is the friendliest, and probably the most advantageous to everyone here in the room. So, not everyone needs to be the next Sam Zell, you know what I mean? And sometimes you just have to realize, hey, look, I just want to get to a point where I'm making, $10,000, $20,000 a month or whatever it is in free cash flow for my properties. I raise money from some family and friends. I'm giving them a good return. And at that point, I'm happy living that lifestyle that you want. So it really depends on the type of person that you are and what you're trying to get out of, this business. But for me, it's really about trying to create an institutional platform that's bigger than me. You know what I mean? So
We got time for one more. Anybody got one? No? All right.
You mentioned, so the Calorama deal, when you have one investor that's that big and you're putting no equity into the deal, does he have control on when to sell the property?
yeah, so typically institutional capital, they have, and I guess this guy, we're counting that because he put up all the money, they have major decision controls, right? So if one day he wants to sell, he can sell. If we want to refinance, he's going to refinance. So there are a couple categories that he can elect to trigger if he wants. But in theory, he could actually fire the manager. Like he could fire me as the manager, but I'm still entitled to my 20% promote if he doesn't like me tomorrow for whatever reason. So institutional capital, it depends on what the operating agreement says, and all this is negotiable. And from the capital that I raise from my family and friends, that I have all the decision-making ability, right? Because I don't want Cassidy's aunt to be like, hey, I want to sell the property because I just got divorced, right? And I need the money. And I'm like, hey, that sounds like a personal problem. Like this investment, I'm running the show here. I'm the pro here, right? So we're going to sell at the opportune time, right? We're not going to sell because some shit happened to you and all of a sudden you're in a bind and now that's my problem. You know what I mean? And institutional capital, they don't usually run into stuff like that, right? Then it's basically all business and math, right?
But this guy, just one guy, if he gets a divorce in 7 months, he
Yeah.
can say, let's sell it. And even if it's at a loss, and you're like, well,
In theory, that could happen. That could happen. And that's why it's better to raise money from the family and friends round and the sub-institutional grade, because you have the decision-making ability. And like I said, if I was trying to raise $11 million and I raise all of it for $250,000 checks, for example, then it's a lot of checks, but no one has any decision-making ability. I'm the general partner. I'm running the show. I'm the expert. And that's what I tell a lot of people. They're like, well, what if we want to sell in 3 years? I'm like, look, you're investing in me because I'm a subject matter expert in this market, and that's what you're investing in, right? You don't know what the cap rates are in this market. You don't know what the interest rates are in this market. You don't know if the market's going up or down. So if you want to sell in year 3 because that's how you're feeling, right, then you should buy stocks where you can just buy and sell on the click of a button, right? You're trusting me. right, to make these decisions for you because I'm the one that's the expert in this. So there are pros and cons back to where you get the capital from. The family and friends, typically you have the decision-making ability. But like I said, like I told my associate who was like, well, we're getting screwed on this, we're getting screwed on that. And I'm just like, look, whoever has the money makes the decisions. It's that simple, right?
Golden rule.
Yeah, whoever's got the money, you need their money or not, you know what I mean? So whatever you can get away with the negotiation, great, right, for you. But at the end of the day, there are pros and cons to different levels of capital and decision-making abilities that are tied to those capitals. But typically the family and friends rounds are the most favorable in terms of returns, in terms of decision-making abilities. Once you start taking more of this institutional capital, that's when it comes with a lot of strings.
It all comes down to how you want your business model to look.
Yep.
Right. And how you want your life to be on a weekly, daily basis.
Yep.
Right.
And sometimes, that family and friends money or your own money, like that could lead to the most freedom.
Yeah.
I'm beholden to a lot of people, you know what I mean? So that comes with a lot of pressure, that comes with a lot of responsibility, and a lot of people don't want that, So I know it looks amazing right on paper when you're talking about it, but when you look at what is behind that and what you're committing to, that's really when you start to realize that it might not be as great as it sounds. So not to leave on a gloomy note.
That was Felipe's therapy session. Right?
Exactly. Don't take institutional capital.
All right, well, round of applause. We're all going to be here. Make sure, again, we're doing that giveaway for the free Airbnb stay. Put your business cards in there. If you want to put your name in for it. We'll hang out for a little
hang out
bit,
for a
but-
while, yeah.
Yeah, thanks, guys. Appreciate it.
Yeah.
Here, do you just want to write down like phone number, email, name of your company? And I'll shoot you an email tomorrow, connect with you. And get you an introduction to our leadership team.
Yeah, that'd be great. My handwriting is atrocious,
That's okay.
so you're gonna have to work with me.
Yeah, that's Suzanne Hillman one. Papers for her.
Harmon?
Yes,
Okay.
H-A-R-M-O-N.
Okay.
Yeah, I don't have a problem with that.
What's the name of your company again?
Harmon Capital Group.
Oh, okay. Perfect.
Yeah.
Okay.
Yeah, look forward to getting that email.
Yeah, definitely. It'll come from Ally, like Leslie Dorr, that's women's door and Ally Families. So, yeah, definitely.
Well,
Love
great
to
meeting
connect with you again. Great to meet you.
What's the other news? Please connect. Great job.
I'm familiar with so I'm familiar with the platform and similar to how do you require a platform like that that allows investors to get
Yeah, I feel all these platforms, so COVID they were really popular, and then now they're kind of the market kind of standing. It depends. Like, I think that they can be added out like a platform and really so we could do it. I think it'd be great. But usually it's a lot of people putting in like $5,000 for you like a yeah, I think that would be great, but I know some of these platforms like that so I would just be mindful of the requirements are. But I mean, by all means, like, we're trying to raise money from anywhere, so if you have an audience like that, I think it's So that's a great question. Do you know what I'm saying? Internal rate of return is an IRR. Okay, so institutional capital, they want a 15 IRR. So when they run the numbers, anything that's over 15 IRR is probably a good thing. They're hard to find, but what I would recommend is you need to come up with your own investment criteria. How much money do you want to get on your money? Early on, I started out only making this difference around my money. That was like my first year. So that's what I would recommend. Come up with your own investment criteria that are like, hey, right? And then from then, you can start sourcing deals, like running the numbers, seeing how they can do it. And if you notice that you're underwriting $100, right? Just to do that. That's about the financial market. Then maybe your financial market is high, right? deals are always good, right? And I think you keep looking. So that's what I'm trying to what's your goal What about rates? I got some